Trideep Bhattacharya is with us, Chief Investment Officer, Equities at Edelweiss Asset Management Company. Trideep, good morning. Good to have you here. Thank you for your time. We're in the earnings season, so I guess we lead with that. IT, not really all that great. And maybe a little bit more in terms of deceleration before things turn. Banking, there's going to be margin pressure as numbers start to pour in over the next 2 weeks. And maybe estimates, overall full year estimates will have to be brought a little lower compared to where they are. In that relation, where are markets according to you at an index level? Remarkably stable. There's a lot of money which keeps coming in. There's a fair bit of supply as well. So it's almost in a unreal equilibrium so far, Trideep.
Yeah. Morning. Thanks for having me on your show. I would say, you have to see the current quarter results in the context of what India has been going through for the last year. So there's been an earnings downgrade cycle which has been prevalent in India since actually middle of last year. And I think the current quarter is symptomatic of that. That by and large, whether it is IT or for that matter, consumption or financials or all the larger sectors, I doubt if we see major earnings upgrades on a net balance basis. There could be companies who could have earnings upgrades overall on an individual basis, but unlikely to see upgrades on a holistic basis. So that's where we are. And that's the reason why the markets have kind of, after reaching closer to September last year's levels, are kind of taking a bit of a breather. The good news is in this that the economic decision making, which is the fodder for ultimately earnings over a period of time, has started coming through since the beginning of this year. Liquidity conditions have started easing. But all of these takes a bit of time to kind of get percolated into earnings. So my sense is that this earnings downgrade cycle will finally end probably as we get towards the back half of this year. A couple of sectors will actually lead that. But till that time, I think particularly in the quarter that you are seeing results right now, I would expect a fairly kind of lackluster earnings on the whole. The commentary will reflect a bit of optimism. And external-facing companies would actually allude to more, or they are alluding to more uncertainty with regards to tariffs not ending. When we had this beginning of this 90-day window, we thought that by the time we get to the end of 90 days, there will be clarity. But at the moment, we still have deals, but not agreements. So that's where we are right now.
By the way, I just want to point out, let's pull up Lead Revenues Tech Ixigo once again. And it just kind of underlines how hungry this market is for growth. And wherever it sees growth, it's willing to latch on because there aren't too many growth opportunities present when you're looking at numbers these days. For late revenues, the revenue is up 73%. The margin, one can argue that the margin's actually down 100 basis points year on year. But for the time being, profit is up about 27, 28% as well. For the time being, the market is just looking at, here's a company that's at least delivering 70% kind of growth in a sector that anyway seems to have a lot of tailwinds. Trideep, hi, morning. I remember you saying that you actually like this space, this way of playing discretionary consumption through lifestyle, leisure, travel. Give us your sense. What kind of stocks or, are you still, overweight on this part of the market, hotels, etc.? Because that's the problem. You need to find pockets where there is at least growth.
Absolutely, and I think relatively, whether you take look at three pockets, selective pockets where we are positive on, would be kind of in a broader level of consumer discretionary, which would be hospitals, hotels, capital markets. These would be three areas. These are small parts of the overall market, mostly prevalent on the mid-cap domain. But this is the area that we still see meaningful amount of growth coming through. So if you divide consumption into three buckets, one is the luxury consumption, second being mass consumption, and third being rural consumption. I think luxury consumption is what I'm talking about, which is still robust. Rural consumption is actually seeing a bit of uptick. Mass consumption is where we are struggling. So the other two parts of the consumption, which mostly falls in the discretionary part, is something that we are positive across in our portfolios. It has played out well, I think, from the way their outlook is seeming to be. One of the hotel companies reported yesterday, they reported fairly robust numbers that go on to show that the segment is doing just quite well.
All right. Hi, Trideep. Good morning. Good to see you in. What's not doing too well is tech. the numbers that we've seen so far haven't been very, very inspiring. The bullish argument is how much lower can these stocks go, because in the next couple of quarters, the street is factoring in that we'll have a more rational Trump, and the spends will improve, which in turn will then give some kind of support as valuations are attractive. Are you in that camp that believes that tech is now getting to that phase where you want to dip in?
Rational Trump might be the the most strenuous assumption that one is making. But jokes apart, I would say that I would put it IT services actually basing out, if I may use that word. Essentially, if you look at this is the worst possible circumstances of decision making for the clients of IT services, which is mostly in the United States. They don't know what tariff is going to end up like. And what business conditions might end up over a period of time. So in these circumstances, the growth that you see, the outlook that you see is probably the worst possible thing that you can kind of think about, barring a global recession, of course. So in these circumstances, the stance we have taken is we have closed our underweight on the sector. We are broadly neutral across our strategies. And we think that we'll kind of tide out this tariff tantrums to the extent that we can, as close as we can get to the end, and then gradually ratchet up. So the direction going forward might be up rather than down, but at the moment, it'll be more neutral in our portfolios. That's how I would put it. With earnings probably basing out, in this quarter and probably the next one.
Trideep, I was listening to. There are, of course, people like Narain, etc. Again, doyens of fund management industry. There's one view, right? Who've been saying that markets, things are finely priced, things are discovered, things are. And so it kind of limits one's opportunity and upside, etc. So, what you buy, it makes a lot of difference to eventual outcomes in that sense. Are you in that camp, or you think there are still lots of single stock ideas? At the end of the day, you don't have to buy a sector, you have to just buy one name, right? You think that is available within pockets?
So I think at a broader level, markets are fair value. And if you look at markets in a slightly top-down from a multi-year standpoint, I would say the markets were carried by a capex cycle over the last 3-4 years, pre-election last year. And since the elections, overall, decision-making is just about starting. It's waiting to see the next earnings trigger, or the sector leader, which can take us through to further higher levels over the next 3-4 years. That at the moment ain't visible, which is why the markets are kind of, broadly at similar levels at past. And what we have to do in these circumstances from the near-term standpoint is rely on stock picking ideas in specific niches where demand is still robust, the three sectors that we talked about, till the time we latch on to the next earnings upgrade driver, which, the chances are, if you ask me, could be consumption. But at the moment, we don't see that the triggers for that. But as we get to the back half of this year, we all know that oil has cracked quite a bit. Inflation is down. We do have a bit of a tax breather that's been given by Honorable Finance Minister. Financial conditions have eased. So all of these could turn out to be a meaningful catalyst for consumption, which could be the driver of next earnings upgrade cycle as we get to the back half of this year. And that's what I think the market is waiting for. So till that time that comes through, I would agree that the markets are in fair value. We have to rely on stock picking in niches to tide through this time, and then catch on to the big earnings upgrade driver to hopefully take the markets onwards and upwards for the next 3-5 years.
Trideep, so finally, tell us, have you been undertaking any major portfolio changes? What are you doing? Any churn? Given the kind of market that we're in, it's range-bound, it's consolidating, and there are only very few pockets of earnings growth. So, what are the changes that you've undertaken, and what would the advice be to investors?
I think at the moment, the advice to the investors would be there are three ways to invest in market at any point in time. One is a lump sum. Second is basically an STP staggered over a period of time. And third is buy on declines. My read on the market currently is that it's a buy on declines market rather than the other two that I talked about. That's one way to think about it. The second way to think about it is, we believe that markets are at broadly fair value. The way to outperform markets is basically bottom up stock picking in and around the niches. So the three sectors that the three segments that I talked about. Apart from that, we've increased our weightage a bit in the chemicals space, where we think that certain specific fluorination, etc., could be going through a bit of a earnings rebound over the next 3-5 years. So that's another area that we have added on to. IT services, we have closed our underweight, taking advantage of this weakness to go to more neutral oriented stance. And finally, in consumer discretionary, we have added on to certain sectors or certain segments where we were not overweight. So those are the three areas that we have gone overweight. The areas that we have gone light on would be commodity-led sectors. We think that given there is a deflation in China going on, overall, that will kind of keep that side of the equation broadly in a bit of a headwinded environment. So that's the reason we have taken a bit of weight off from the commodity-related sectors.
Okay, all right. Understood. Thank you for that perspective. It's helpful, Trideep. And thank you for being with us this morning as well. We look forward to another session soon on this one.